Is the EWU the key to unlocking European riches? Not quite that simple, but it can be a powerful tool for getting exposure to the UK stock market. We'll break down everything you need to know. Concentration versus diversification. Is the EWU all about big-name companies, or does it offer a broader spread? Hunting for yield. Can the EWU be a good income source, or is it more about growth potential? Beyond the EWU, are there other ways to invest in Europe, and how does the EWU stack up? So buckle up, ETF explorers, because we're about to dive deep into the world of the EWU. Question 1. What is EWU ETF? The EWU ETF, which stands for iShares MSCI United Kingdom ETF, is an exchange-traded fund designed to track the performance of the UK equity market. Here's a breakdown of what EWU offers and some key things to consider. Investment objective. EWU seeks to mirror the investment results of an index composed of UK equities. This means the ETF holds a basket of stocks that represent a significant portion of the UK stock market. Tracking strategy. EWU likely uses a physical replication strategy. This means the ETF directly holds the underlying stocks in proportion to their weighting in the tracked index. This approach aims to deliver performance closely aligned with the index, minus the fund's expenses. Benefits of EWU. Targeted exposure. EWU provides a convenient way to gain exposure to a broad range of companies listed on UK stock exchanges. This diversification helps mitigate risk compared to picking individual stocks. Market efficiency. ETFs like EWU typically trade at prices close to their net asset value, NAV, reflecting the underlying holdings value. This makes them generally cost-effective compared to actively managed funds. Liquidity. EWU trades on the NYSE Arca exchange, offering high liquidity. Investors can easily buy and sell shares throughout the trading day. Dividend reinvestment. Optional EWU may offer a dividend reinvestment plan, DRIP. This allows automatic reinvestment of distributed dividends to purchase additional shares, potentially accelerating wealth accumulation over time. Things to consider before investing in EWU. Market risk. The overall performance of the UK stock market will significantly impact EWU's value. Investors should be comfortable with potential market fluctuations. Currency risk. The value of EWU will be affected by exchange rate movements between the investment currency and the British pound. Concentration risk. While EWU offers diversification, it may still have some concentration risk. The top holdings could have an outsized impact on the ETF's performance. Expense ratio. EWU charges an expense ratio to cover management fees and operational costs. Understanding this cost is crucial to assess the ETF's overall return potential. Investment goals. Align EWU with your investment goals and risk tolerance. Consider your investment horizon and how EWU fits within your broader portfolio strategy. Alternatives to EWU. Other UK ETFs. Explore ETFs offering more targeted exposure to specific sectors within the UK market. Europe ETFs. Consider broader Europe-focused ETFs for diversified exposure across multiple European countries. Actively managed funds. Research actively managed mutual funds that invest in UK equities and potentially outperform the market, though come with higher fees. Direct stock picking. For experienced investors, directly investing in a basket of UK stocks allows for greater control, but requires more research and management effort. Question 2. What is the primary objective of the EWU ETF? The primary objective of the EWU ETF, or iShares MSCI United Kingdom ETF, is to track the investment results of a market capitalization weighted index of UK equities. In simpler terms, it aims to deliver a performance that closely reflects the overall performance of the UK stock market. Here's a deeper dive into this objective. Market cap weighting. The index the EWU tracks likely weights each company within the index based on its market capitalization. Market capitalization is calculated by multiplying the stock price by the number of outstanding shares. Companies with a larger market cap, higher stock price, or more shares outstanding will have a greater weighting in the index and, consequently, the EWU ETF. This means the ETF's performance is heavily influenced by the performance of these larger, more established companies in the UK market. Passive management. The EWU ETF is passively managed. This means the fund manager doesn't try to outperform the market by picking individual stocks they believe will rise in value. Instead, the ETF simply holds the basket of stocks in the tracked index, aiming to replicate its performance, minus the fund's expenses. Benefits of tracking a market index. Diversification. By holding a basket of UK stocks, EWU offers investors exposure to a variety of companies across different sectors of the UK economy. This diversification helps spread risk compared to investing in just a few individual stocks. If one company performs poorly, it will have a smaller impact on the overall performance of the ETF compared to owning that stock directly. Market efficiency. Market capitalization weighting is a widely used method to capture a representative slice of the overall market. Theoretically, the companies with the largest market caps tend to reflect the broader market trends. This passive approach aims to be cost-effective as it avoids the higher fees associated with actively managed funds. Transparency. The holdings of the index that EWU tracks are typically publicly available. Investors can understand the specific companies they are gaining exposure to through the ETF. Important caveats. Tracking error. While EWU aims to mirror the index performance, there may be a slight difference due to various factors like expense ratios and infrequent rebalancing of the ETF holdings. This difference is known as tracking error. Market performance. The success of the EWU ETF hinges on the performance of the UK stock market. If the overall UK market experiences a downturn, the value of the ETF will also decline. No outperformance guarantee. By passively tracking the market, EWU doesn't guarantee outperforming the market. Actively managed funds that attempt to select stocks that outperform the market might achieve higher returns, but they also come with higher fees and potentially greater risk. Question 3. How does the EWU ETF track the underlying index? The EWU ETF, or iShares MSCI United Kingdom ETF, most likely uses a physical replication strategy to track the performance of its underlying index, which is typically the MSCI United Kingdom Index. Here's a breakdown of how this strategy works. Physical replication explained. 1. Index composition. The MSCI United Kingdom Index includes a specific set of companies listed on UK stock exchanges. Each company within the index has a weighting based on its market capitalization, market cap. Companies with a larger market cap have a greater influence on the index's overall performance. 2. Physical holding of stocks. The EWU ETF physically purchases shares of each company in the underlying index. The number of shares purchased for each company directly reflects its weighting within the index. For instance, if Company A has a 5% weighting in the index, the EWU ETF will likely hold shares of Company A that make up approximately 5% of the ETF's total holdings. 3. Rebalancing. To maintain alignment with the index, the EWU ETF periodically rebalances its holdings. This might involve buying more shares of companies whose stock price has increased, proportionally increasing their weight in the index. Conversely, the ETF might sell shares of companies whose stock price has fallen to maintain their appropriate weighting. Benefits of physical replication. Transparency. Since the ETF holds the underlying stocks directly, the holdings are typically publicly available. Investors can gain transparency into the specific companies they are exposed to through the EWU ETF. Tax efficiency. In a physical replication structure, dividends from the underlying stocks are typically passed through to the ETF shareholders. This can be tax efficient for investors in certain tax brackets, depending on the specific tax treatment of dividends in their jurisdiction. Challenges of physical replication. Tracking error. While the goal is to perfectly mimic the index performance, there can be a slight difference known as tracking error. This can arise due to transaction costs. Buying and selling underlying stocks incurs transaction costs, brokerage fees, bid-ask spread. These costs can eat into the ETF's returns, causing a minor deviation from the index performance. Cash drag. The ETF might hold some cash to facilitate transactions. This cash portion doesn't generate returns like the underlying stocks, introducing a minor drag on the overall performance. Rebalancing frequency. Rebalancing doesn't happen continuously. There might be a lag between market movements and the ETF's rebalancing activity, leading to a slight tracking error. Alternative replication strategy. Synthetic replication. Some ETFs use a synthetic replication strategy to track an index. This method involves swaps with counterparties to achieve similar returns to the index, without directly holding all the underlying assets. While potentially more efficient, synthetic replication can introduce counterparty risk, meaning the ETF's performance relies on the financial health of the swap counterparty. Question 4. Does the EWU ETF distribute dividends or reinvest them? The distribution policy of the EWU ETF, iShares MSCI United Kingdom ETF, depends on the specific investment account you hold it in. Here's a breakdown of the two main possibilities. Option 1, Dividend Distribution. Default setting. In many brokerage accounts, the default setting for ETFs, like EWU, is to distribute dividends received from the underlying stocks. This means the EWU ETF itself doesn't retain any dividends it receives from the companies it holds. These dividends are periodically distributed to shareholders in proportion to their holdings in the ETF. You, the investor, will receive the dividends as cash deposited into your brokerage account. Benefits of dividend distribution. Regular income stream. Distributing dividends can provide a regular source of income for investors, especially those relying on their portfolio for income generation. Tax implications. Depending on your tax bracket and jurisdiction, qualified dividends, which may include some or all of the EWU's distributions, might be taxed at a lower rate compared to ordinary income. However, consult a tax professional for specific advice in your situation. Drawbacks of dividend distribution. Reinvestment responsibility. If your goal is to grow your wealth through compounding returns, you'll need to reinvest the distributed dividends back into the ETF or other investment opportunities. This requires manual action on your part. Tax implications. Even with potential tax advantages, receiving dividends can still trigger taxable events. Consult a tax advisor to understand the tax implications for your specific situation. Option 2, Dividend Reinvestment, DRIP. Alternative option. Some brokerage accounts may offer a dividend reinvestment plan, DRIP, for ETFs like EWU. A DRIP allows you to automatically reinvest the distributed dividends back into additional shares of the ETF. Benefits of DRIP. Compounding growth. By automatically reinvesting dividends, you can benefit from compounding returns. As the ETF share price appreciates, future dividends will be based on a larger holding, leading to accelerated growth over time. Oh, convenience! DRIPs eliminate the need to manually reinvest dividends, simplifying your investment management process. Drawbacks of DRIP: limited availability. Not all brokerage accounts offer DRIPs for all ETFs. Check with your broker to see if this option is available for EWU in your account. Fractional shares. Depending on the DRIP program and the dividend amount, you might receive fractional shares when reinvesting. Some DRIPs may accumulate these fractions until enough are available to purchase a whole share, potentially causing a slight delay in full reinvestment. Question 5. What is the expense ratio of the EWU ETF? How does it compare to other similar ETFs? EWU expense ratio and comparison. The expense ratio of the EWU ETF, iShares MSCI United Kingdom ETF, is currently 0.5%. This expense ratio represents the annual fees charged by the fund to cover its management and operational costs. These costs include management fees, paid to the fund manager for overseeing the ETF's investment strategy and portfolio. Administrative expenses, costs associated with running the ETF, such as legal fees, audit fees, and custodian fees. Impact of expense ratio. The expense ratio directly affects the ETF's overall return. A higher expense ratio eats into the investment returns generated by the underlying holdings. For example, if the EWU ETF tracks the UK market and the market delivers a 10% return in a year, the expense ratio of 0.5% would be deducted from that return. Investors would then receive a net return of approximately 9.50%. Comparison with similar ETFs. Here's a comparison of the expense ratio of EWU with a few other popular UK equity ETFs. Vanguard FTSE UK All Cap UCITS ETF, VUC expense ratio 0.09% as of April 21, 2024. SPDR SP UK High Dividend UCITS ETF, SPUK expense ratio 0.3% as of April 21, 2024. iShares Core FTSE 100 UCITS ETF, ISF expense ratio 0.12% as of April 21, 2024. Observations. EWU has a higher expense ratio compared to some competitors, particularly VUC, which offers significantly lower fees. However, EWU might offer some advantages in terms of liquidity, trading volume, or specific features depending on your needs. Choosing the right ETF. When selecting an ETF, consider the following factors in addition to the expense ratio. Tracking index. Does the ETF track the same or a similar UK equity market index as EWU? Underlying holdings. Does the ETF provide the desired level of exposure to specific sectors or company sizes within the UK market? Liquidity and trading volume. How easily can you buy and sell shares of the ETF? Investment objectives. Does the ETF align with your overall investment goals and risk tolerance? Question 6. How liquid is the EWU ETF? The EWU ETF, iShares MSCI United Kingdom ETF, is considered a highly liquid investment. Here's a breakdown of what liquidity means for ETFs and how EWU stacks up. Liquidity explained. Liquidity refers to the ease with which an investment can be bought and sold at a fair market price. For ETFs, liquidity translates to the ability to readily enter and exit positions by buying and selling shares on an exchange throughout the trading day. Factors affecting EWU's liquidity. Several factors contribute to the high liquidity of EWU. Large asset base, EWU boasts a significant amount of assets under management, AUM, in the billions, as of April 21, 2024. This large pool of capital attracts market makers who provide bid-ask quotes, ensuring a continuous market for buying and selling EWU shares. Exchange listing, EWU trades on a major stock exchange, likely the NYSE Arca. These exchanges have established mechanisms to facilitate smooth trading and attract large institutional investors who contribute to trading volume. High trading volume, EWU, typically experiences high daily trading volumes, meaning a large number of shares are bought and sold each day. This high volume indicates active trading and reduces the risk of wide bid-ask spreads, the difference between the price a buyer is willing to pay and the price a seller is willing to accept. Benefits of high liquidity. Reduced transaction costs. High liquidity often translates to tighter bid-ask spreads, minimizing the cost difference between buying and selling EWU shares. Easier entry and exit. Investors can enter or exit their EWU positions with greater ease due to the readily available market for buying and selling shares. Reduced price impact. Large trading volumes help absorb buy and sell orders without significant price fluctuations, minimizing the impact on the overall ETF price when entering or exiting a position. Liquidity, compared to other ETFs. While EWU is generally considered highly liquid, some alternative UK equity ETFs might even have higher trading volumes. However, it's important to consider the specific needs of your investment strategy. For instance, a smaller, less liquid ETF might offer more targeted exposure to a specific sector within the UK market. However, you might face wider bid-ask spreads and potentially. Question 7. How is the EWU ETF exposed to overall market fluctuations? The EWU ETF, iShares MSCI United Kingdom ETF, is inherently exposed to overall market fluctuations in the UK stock market. Here's a detailed explanation of how this exposure works. Underlying mechanism. Market capitalization weighting. The EWU ETF likely tracks a market capitalization-weighted index of UK equities. This means companies with a larger market cap, higher stock price or more shares outstanding, have a greater weighting within the index and consequently within the EWU ETF. Performance correlation. The performance of the EWU ETF is heavily influenced by the performance of the companies it holds. If the overall UK stock market experiences an upswing, the share prices of the companies in the ETF will generally trend upwards, leading to an increase in the net asset value, NAV, of the ETF and its overall price. Conversely, a downturn in the UK market will likely cause the share prices of the holdings to decline, decreasing the NAV and price of the EWU ETF. Factors affecting market fluctuations. Several factors can influence overall market movements in the UK. Economic conditions. The health of the UK economy significantly impacts corporate profitability and investor sentiment. A strong economy with GDP growth, low unemployment, and stable inflation typically fosters a bullish market environment, potentially leading to rising stock prices and a higher EWU ETF price. Conversely, economic recessions or slowdowns can trigger market sell-offs, potentially causing the EWU ETF price to decline. Interest rates. Changes in interest rates set by the Bank of England can affect investor decisions and stock prices. Lower interest rates can make stocks more attractive compared to bonds, potentially leading to a rising market and higher EWU ETF price. Conversely, rising interest rates might incentivize investors to move towards fixed income options, potentially leading to a market decline and a lower EWU ETF price. Company earnings. The performance of individual companies within the EWU ETF also plays a role. If a large number of companies report strong earnings that exceed analyst expectations, it can boost investor confidence and potentially lead to a rising market and a higher EWU ETF price. Conversely, disappointing earnings reports can trigger market corrections and potentially cause the EWU ETF price to decline. Global events. Major global events like geopolitical tensions, trade wars, or oil price fluctuations can create uncertainty and impact investor risk appetite. This can lead to market volatility and potentially significant swings in the EWU ETF price. Strategies to manage market exposure. Diversification. While EWU offers exposure to a basket of UK companies, consider further diversifying your portfolio across different asset classes like bonds, commodities, and international markets. This can help mitigate the impact of market fluctuations in the UK. Long-term investment horizon. Market fluctuations are inevitable. By adopting a long-term investment approach and focusing on your long-term goals, you can potentially weather market downturns and benefit from potential market recoveries over time. Dollar cost averaging. Investing a fixed amount at regular intervals throughout the market cycle can help average out the cost per share of the EWU ETF. This can be a good strategy to manage the impact of market volatility on your overall investment cost.